Hi, everyone. Welcome to the latest Facts versus Feelings, Take 5 with Ryan and Sonu. Sonu, we're titling this one, Why We're Not Worried About $1 trillion in Credit Card Debt. I've heard a rumor. You've been running up your credit card. Is that true, Sonu?
I have been running up my credit card because everything costs more, especially when you compare it to like 3 years ago. Plus, I have two kids, so they're starting to eat more. So they just turned 7, and 3 years ago they weren't eating as much. So that's been a big change.
Yeah, that's true. The twins are getting bigger. So Sonu, let's dive into it. We've heard the headlines. You've all heard the headlines. $1 trillion in credit card debt. Our friends at the Fed, New York Fed, come up with this data every quarter, and I believe it's 1.03. But we've cracked the $1 trillion of credit card debt. That's the headline. That's the worry that the consumer is tapped. We're going to talk about some of these things that we're not so sure that's a big worry. Sonu, I'll start and hand it over to you. Let's start high level here. I call this denominator blindness. What do I mean by that? Well, the numerator, that's overall debt. But if you look at the denominator, things like overall net wealth, everyone, went from 44 trillion in 2000 to nearly 150 trillion right now. So if you're worth a lot more, you might have a little more credit card debt. Let's just take a second and think about housing. If you own a house, what's the value of your house done, right? The last couple of decades, significant equity in people's housing. So we're not minimizing $1 trillion of credit card debt. What we are saying, though, is it kind of makes sense. If you're worth a lot more, you might have more debt. Now, Sonu, I want to ask you this. We've heard rates, we all know, right? Rates have gone up a lot. Just the financing on credit cards have hit like some of the highest levels we've ever seen. Should we be worried, though, if people can't afford this $1 trillion credit card debt with all the high financing fees that they're going to be hit with?
Yeah, I think when you think credit card debt, normally everyone focuses on that headline, okay, $1 trillion. But, you look at how much does it cost to service the debt? Yes,
Yep.
interest rates have gone up, and you think, okay, maybe there's some trouble there, right? But look, incomes have gone up too. You're talking about household wealth, right? But the day to day, a lot of the spending is financed by incomes, right? And so if you look at debt service costs, how much does it cost to service credit card debt, all of that, as a percent of household disposable income, right, after taxes and all of that, that's running under 10%. Before the pandemic, it was about 11%. Historically, that's where it's been, 11 to 11.5%, something like that, right? And if you take total debt even as a percent of household income, disposable income, that's running about 21%. Historically, that average has been about 26%. And that's one reason why I think when I look at all of this stuff, and same thing, you've done some great work on this, why we're not worried about $1 trillion in credit card debt.
Yeah, exactly. And again, we're aware of the concerns when you see the headlines, the nightly news. We get it. But again, when you peel back the onion, you see some other things. One other one, Sonu, on this, there's something called credit utilization. We're going to keep this very simple. It's how much you're using relative to your balance. Here's an example. $10,000 credit card balance, your credit utilization is probably about $2,100, which is 21%. That's what we're running, 21% credit utilization right now. That's well beneath pre-COVID levels. So again, it doesn't seem, everyone, like we are just maxing out our credit cards to get the economy going and to keep things going. In fact, it's kind of the opposite, which again is not what you hear on the nightly news. Now, Sonu, let's talk a little more about the consumer. Just recently, we saw retail sales come in really strong, once again, surprising nearly everyone that the consumer is still out there spending. Take it away.
The consumers they're spending more than anyone expected, to be honest, and on online spending, so things like Amazon, whatever it is, but even restaurant and bar sales, right? All of that's been very strong too. So over the 3 months, May, June, July, retail sales, the July number is really strong, but you always want to take some sort of average because these things get revised and there's noise and all of that. Take the average, May, June, July. Retail sales spending and food services, right? Restaurants, bars, that was running about 5% at an annual pace. That's massively strong, right? And then you think, okay, what happens if you adjust all that for inflation? Now, inflation over that same 3 months has been running just under 2%. Believe it or not, Ryan, that's the other side of it. Inflation is coming down, right? That's the good news. So you take the 5 minus 2, it's a rough approximation of what, real growth, inflation adjusted growth is. That's about 3%, right? That tells you, that gives you a good idea of the economic speed. How fast is the economy growing today? I mean, 3% sounds pretty, crazy because we haven't seen that type of growth in the last decade. That's massive.
No, again, that's surprising. Probably a lot of people out there. Also, like you mentioned, restaurants are strong thanks to your twins. You have to pay a little more money to feed them as they're getting bigger. Sporting goods, I know, was also strong. Online
Mm-hmm.
sales, right? These different areas, they continue to
Yeah.
surprise to the upside. Now, Sona, we've got approximately a minute or so left. One of the things we've been hearing about is a surge in bankruptcies. Can you talk a little bit about, should we be worried about that big surge in bankruptcies? Because in a way, credit card debt and bankruptcies, these are the two headlines we've seen the last month or so.
They're almost like two sides of the same coin, right? Or
Yep.
credit card debt, that's a consumer side, households, and then or bankruptcies, that's a business side of things, right? But again, you look at if you're thinking business bankruptcies, what's the first place you look at to see? Should I be worried about this? You look at what bond investors are doing, because what do bond investors do? They lend money out. They lend money to the government, that's treasury debt, but they also lend money to the companies, right? Now, if they're worried about companies going under, not being able to pay back debt, they would charge a higher interest rate relative to treasuries, right? Are they doing that? No, they're not doing that, right? So that's one massive thing that tells us that, look, investors are not worried about it. And then banks who lend money to companies, they're not seeing rising delinquencies or anything either, right? All of these are like, the delinquency rate on loans is less than what they saw before the pandemic. So again, notch it up, notch one more reason why we're not worried about corporate bankruptcies.
Yeah, exactly. I mean, we have the data again, like 90-day delinquencies and things like that. They're simply not soaring at all relative to what you
Mhm.
think. We have seen a little surge in auto loans, but again, it's almost where we were pre-COVID levels. So
Yeah.
again, it's not an easy picture. We're aware of the concerns, but we just still think that you should not be as worried about $1 trillion in credit card debt as everyone makes it sound. That's the latest. Facts versus feelings, take 5. We'll see you next time. Take care.